Hello, I'm Fenton Bergin and welcome to our quarterly review of loan market conditions and our outlook for the next 3 months. Uncertainty with a capital U is set to continue to be the central theme over the next few months, with the recent announcement of the UK general election and other major elections taking place across Europe. We're also seeing evolving policy announcements from a newly elected US government on both its domestic and foreign policy. The Global Economic Policy Uncertainty Index is at a record high, reflecting these broader conditions. So what does that mean for corporate borrowers? Conventional theory dictates that in times of uncertainty, 3 things happen. Borrowing costs go up, corporate loan syndications get stuck, and liquidity vaporizes. Right? Well, wrong. Now is actually one of the best times to be a borrower of the last 10 years, with terms and conditions right back to where we were pre-Lehman's crisis. Let's look at what's happening. Actually, rather than rising, leveraged loan yields have fallen by as much as 25% from a year ago, and we've seen record percentages of new deals being flexed down on pricing in response to lender demand, and a market that continues to see a lot of companies refinancing to take advantage of market conditions. A record 70% of primary activity has been refinancing driven over the first quarter of this year. In the short term, lender competition may drive loan pricing lower for the very best credits to new record lows, albeit it's difficult to see pricing falling significantly lower. In the US market over the last 4 years, the total amount of covenant-light loans outstanding has tripled today to a record $600 billion, equivalent to 70% of all loans outstanding. We see these trends continuing over the next quarter, with a range of 2015 and early 2016 deals rolling off their non-call periods and looking to refinance. Remarkably, despite uncertainty, secondary loan prices have increased over the last 6 months, and the median trade prices on primary loans are above par in the first 3 months of this year. Far from vanishing, lending liquidity from banks and funds is at a close to record level, with 87% of European direct lending deals tracked by the Deloitte Alternative Lender Deal Tracker over the last 12 months being completed with one lender, as opposed to a club of lenders being required by the borrower. Average leverage multiples are back to pre-crisis highs of in excess of 5.5 times debt to EBITDA, and this is pushing valuations on new deals higher, with average deal purchase price multiples now in excess of 10 times on both sides of the Atlantic. I don't see those dynamics changing in the short term. So why is this happening? Firstly, in a low interest rate environment, we've continued to see a wide range of investors targeting corporate lending strategies to secure yield. There are now in excess of 60 direct lenders operating in Europe, with in excess of 40 billion euro of dry powder to deploy. Many of these funds can now lend up to £200 million on a single credit, making them far more relevant to private equity funds. Secondly, the ECB continues to pump prime the European economy, having confirmed it will continue its quantitative easing programme through 2017 at levels equivalent to $2.2 trillion. To put that into context, that's equivalent to more than twice the annual profits of the entire Fortune 500. A lot of that liquidity is supporting the corporate loan markets. Is this wholly positive? Yes and no. Low borrowing costs continue to stimulate economic growth, but they're also fueling intense competition in the lending markets that's driving purchase price up to levels that many commentators and investors see as an overly inflated bubble and where they'll struggle to meet their return targets. Combined with broader uncertainty, this is certainly slowing the M&A market. So what should borrowers focus on right now? Firstly, conditions are very issuer-friendly, both in terms of pricing and structures. In our last update, we flagged that 2017 was likely to be very borrower-friendly, and that's indeed proving to be the case. Secondly, don't forget the fundamentals. In uncertain times, now is a time to be securing maximum flexibility in your facilities, prioritizing covenant headroom, whilst also taking advantage of the very strong pricing dynamics. Thank you for your attention, and we look forward to speaking to you in our next update.